Well, welcome everyone to Getting Started with Technical Analysis. Today we are tackling topic number 4 in our series, and that is candlestick patterns. When I was first introduced to the world of trading back in 2011, and I saw charts, my eyes lit up. I thought they were magical, the story they could tell. And I continue to think they're kind of magical. It's been a really interesting journey in the world of technical analysis for me, and I'm delighted to get to share some of what I have learned with all of you. So, as I said, today we're talking all things candlestick. I posted a summary sheet on X. So, if you wanted to see that, you can go over to X. If you're not following me, consider this my formal invitation from me to you at my handle, Barbara Armstrong CS. We've also got Brett Crowther with us in the chat. He is on X as well, and you'll want to follow him, Brett Crowther CS. So, we're posting lots of content that we think will, be helpful for you. We use the Paper Money software application on the Thinkorswim desktop platform for our examples in this class, and it is a brilliant place to learn. But there are some nuances and differences. One is that short options will never be assigned early in Paper Money. That can happen in a live account. Also be aware that options carry a high level of risk and aren't suitable for all investors. And while we focus on technical analysis in this class, it's called Getting Started with Technical Analysis, other approaches, including fundamental analysis, being aware of earnings, what's going on, globally with respect to trade, the tariffs have certainly had an impact, and we want to be aware of those things as well. Schwab doesn't recommend just using technical analysis. Okay, so here we are on week 4. If you are new to this class for the first time, feel free to type in a greeting so that we can welcome you. And if you are new, you can, instead of binging Netflix, you can do some binge learning and go back, to the beginning of this season. And if you're really keen, this is our second or third time through it. And actually, this class has been taught for years. So you can do some binge learning if you want. And I know that Brett will post a link to this class in the chat, but I will also post a link to that in the show notes below, and it will show up at the end of the webcast also. Okay, so we're going to review some candlestick basics today, talk about the concepts of how candles are created, look at some common candlestick patterns, and then we're going to use that to facilitate an example trade. And in fact, we're going to do a couple of example trades today, so, stay tuned. So how is a candlestick created? Well, we have several components. The first is the body, and the body is created based on where the stock opens and where the stock closes. And if it's an up day, which is, what we're seeing here, then we're seeing, just let me change my drawing tool. We're seeing that it would have opened here or opened here and closed here at the end of the day. Now, if this candle were red, it would be the opposite. It would have opened higher and closed lower. So the rectangle forms what we call the body of the candle. Now, what about these lines coming out of the top and bottom? We call that the wick. And that represents the high and the low of the day. So, if this were a white or a green candle on some of your charts, we'd see, here it opened here, it closed here, and at some point during the day, it went all the way up here, and that was the high of the day, and then also came down here and created a low of the day. Okay, and we call these shadows, or I refer to them as wicks. Some might call this a tail also, this bit at the bottom, but in trader speak, they call that a wick, and it shows us the high and the low of the day. And so it's interesting, when we have a really long wick on something, it means that the bulls and the bears were duking it out through the day and drove the price either way down or way up, and then came back for the close. So here we have our open, our close, our high, and our low. And how do we know it's where the open and the close, it's by the color of the candle. Now, if this were red or black, depending on how you set up your charts, here's our open is at the high, our close is at the low, and the high and the low remain the same. Now, when we have, especially if something gaps up, there are support and resistance levels within candles. And this is, a little more advanced concept, if you will. But if you're trying to determine where to put a stop, say, if something has gapped up and we look at this candle, we could say, well, hey, this level about here could be seen as support level 1. And then if we go all the way to the bottom of the candle, so this is represents about midway. So these would be equal on either side. S2 might be the open of that day. And our support level 3 might be the low of the day. And then it would be the reverse if we're looking at, resistance levels. So, if we had something maybe at the top of a trend and it looked like it was pulling back, you might say, well, I see this as a resistance level, the first resistance level, and this, this open of the day as a second resistance level, and then the high of the day as a third resistance level. And so it works both ways, as so many things do, right? Yeah, like somebody's saying what a story each candle tells. And it's kind of fascinating. So when we see big candles, and we've seen a lot of big candles this year, haven't we, friends? When we see big candles, and if it's a large white candle or a large green candle, well, the bulls are winning, aren't they? So that's heavy buying. So we see that here or here. And when we get to a smaller candle, what we're seeing is that the bulls and the bears, are a little closer to being a draw. So there's, the buying pressure is a little bit stronger, but not quite as strong. Okay. And you may say, well, what defines a large candle or what defines a small candle? Well, I would call, this a large candle. I would say that's large and this is small, and it's just relative. This is a large candle too. So it just depends. Yeah. So, we've got some people here who are here for the first time, and welcome. And if this feels a bit like drinking out of a fire hose, although this is an introductory level class, just know if you keep coming back, it will get easier and easier. I had somebody type into a survey yesterday that, 2 years ago, they felt like they were drinking out of a fire hose and would have had trouble following along. And now they're not missing a trick. Okay, so now where we look at a candle is also important relative to where it is on the chart. And when we see, and this is what many of us look for, is these reversal patterns. And so here, if it's bullish, we'd look for these at a support level or at a floor. And with these bearish patterns, we'd look for these at a resistance level or a ceiling. Resistance is the technical term for it. I still think of it in terms of floors and ceilings. So this would be ceiling, and this would be a floor. Sorry, my handwriting's not the greatest when I'm using this little crayon, that I'm drawing with my mouse. So, and the first one is a hammer pattern, and that is characterized by a long wick at the bottom, a relatively small body. And do we need confirmation? We do. And what is considered confirmation is if we have a close above the body of this candle the next day. Now, an inverted hammer, if you've ever put a hammer down, head down, it's pretty similar, and it doesn't necessarily matter the color of the candle, but what we're looking at is a long wick on top, a small body, and then again, you want confirmation that the next day's candle closes above the body, not necessarily the wick, but the body of the candle the day before. And I've started doing some short videos. I'm going to record some more this week, and I'll show you where you can find them. I've done the hammer, the inverted hammer, the hanging man, and the shooting star, and they're just little 3 or 4 minute videos that just talk about a single pattern. So we just talk about the hammer for 3 whole minutes or 4 whole minutes, or just talk about the hanging man. And I'll show you where to find those. But when we get to piercing line, what makes this a piercing line candle? Well, what makes this a piercing line is that we have a down day, and then the next day, the body of this candle goes more than halfway through the body of the candle of the day before. And so we call this a piercing line. And where does this happen? At a support level. Now, what about bullish engulfing? We've seen a lot of these lately, and we've seen a lot of Harami patterns lately. And a bullish engulfing, what makes this bullish engulfing is that we have a candle approaching a support level, this being the support level, and the next day, this candle encompasses or engulfs. So the body of this candle engulfs the candle of the day before. The body of the candle. Now, what about a harami? Now, this is a Japanese word for pregnant. And so you'll see it kind of looks like a little joey if you think of a kangaroo. So you have this big candle, and then the next day, the body of the candle is totally inside the body of the candle from the day before. And we call that a harami pattern. And if it happens at a support level, it's a bullish harami. If it happens at a resistance level or a ceiling, we call that a bearish harami. And then a morning star pattern happens when you have and this is a bullish pattern. So you have a down day or a red candle. So you have a candle that's coming down, then the next day it gaps down, and you have a small body on that candle. And then the third day, you've got a big up day. It's more powerful the bigger the candle, and if it gaps up, all the better. So this is a 3-day pattern. But some of these, and we're going to go out and look at a bunch of examples on the chart. So we may see this candle and go, oh, that's a hammer. Well, it's not considered a confirmed hammer until we have that close above the body the next day. The same with the inverted hammer. And they don't always follow through. Yeah, so Ranjit is asking, what's the difference between the hammer and the hanging man? And in all honesty, my biggest struggle in teaching this class is that I just call them a hammer in my own mind at both places. The only difference between the hammer and the hanging man is where it is on the chart. So hammer, when it's at a support level, bullish. It's bullish. If this same pattern happens close to a resistance level, bearish. Both of them are an indication that the winds of change may be above us. Now, with the hanging man, we're going to expect that the next day's candle, as you can see here, closes below the body of the hanging man from the day before. If that doesn't happen, then it's not a complete hanging man, if you will. So, and this is considered bearish. Now, you say tomato, I say tomato. We can call it a hanging man, or you can call it a hammer. In trader speak, they call this a hanging man. And then our inverted hammer looks remarkably like the shooting star. What's the difference? The only difference is where it is on the chart. And this can be, a red candle or a green candle, and it still would be considered to be a shooting star. But is the pattern complete looking at one day? No, we need confirmation. And with a shooting star, the confirmation is that it closes the next day below the body of the shooting star. Otherwise, it's not a legit shooting star. Okay. Now, piercing line and dark cloud cover, they look really similar too. And the premise is the same in that you're looking after you've had this big up day for a follow-on, a down day where it closes below this halfway point, right? Or what they would have called R1, resistance level 1. So it doesn't have to close below the whole body. If it closes below the whole body, this is our bearish engulfing, where it opened higher, closed lower, and engulfed the entire candle from the day before. So same thing as bullish, only we're flipping it and reversing it. They're both they're both engulfing patterns. So AJ is saying, can we get this candle stick sheet? Absolutely. Riceberg said, it's a really good slide. Yes, and I will clear it if you want to take a screenshot. But I did post this exact same slide on X, just before the class started. Yeah. Yeah, you know what? Like, I used to have these pinned up in my office when I first got started. So I like posting resources that I have used in the past. So this is our bullish Harami, bearish Harami. Again, we're just kind of flipping it and reversing it. Instead of looking for it at a support level, we're now looking for it at a resistance level. And a Harami is a Harami, right? So like these are the same in that the second candle is inside the body of the first candle. And, this is a bullish and up day. And then all of a sudden you get this red candle that's inside the body of the white candle from the day before. And this pattern does not require technically confirmation. Okay. And then evening star, it's like flip it and reverse so both are stars. We look at both the same way, but we've had an up day. Then often it will gap up and we get this little doji pattern, a candle. So bulls were in charge here, right? Then the bulls and the bears duke it out and kind of come to a draw. And then the bears come in and take charge. And the bigger this bearish candle, the stronger the evening star is considered to be. Okay, so let me wipe the slate clean. Shake my little Etch-a-Sketch. Yeah. Yep, so that you can take that. And let me just look. To be a hammer, does it need to be downtrending? So if it's downtrending, no, it actually doesn't. So Priya asked, I like that question, Priya, because we could have something, so I hope everybody's got this, that's been uptrending like this, right? And then it starts to come down, and then we could get this hammer pattern. They didn't hire me for my art skills. And that could be within the context of a bull flag, which is definitely an uptrending pattern, but it's a short-term pullback within the context of an uptrend. And then what we're looking for here with this pattern continuation is like, is this a legit hammer? We're looking for it to close the next day above. And in fact, hold is close above the high of the low day. That's our confirmation. So if this hammer or inverted hammer is appearing to be the low, what we're looking for before we confirm that is that close above the high of the low day. So great question. Is there a point where the evening star is too strong and it's indicative of a reversion? Oh, so this evening star, if this pulls back, again, this could happen within the context. Again, it could be happening. Let me just draw this here. We could have this evening star pattern happen within the context of this uptrend, where we could have that here, and then our little doji, and then the bearish day. Sorry, I'm massacring that, but we could have that happen within the context of the uptrend, and then we could, end up with a hammer, and it could turn around. So maybe I should have done it this way. Then we have this pattern happen right here, pulls back for a couple of days, and then keeps on going. Yeah, so that can absolutely happen. You guys had really great questions here today. Okay, so let's move on. Okay, you know what? I don't know why I don't have my go to. Let's go out and look at some examples. I guess I need to add that to my chart. So let's come and look at Caterpillar, for example. And let's make this participatory. And so, here, well, let's look at yesterday's candle. What would we have called this candle yesterday? So, this has been moving along, right? Kind of a bull flag pattern. We had a diagonal resistance breakout, and then it gaps to the upside. So what would we call this pattern? Potentially a shooting star. We could call that a shooting star, right? Because it's up near a potential resistance level. If we look at this, oops. So it'd come up, if I draw a line here, so could this have been broken through this potential area of resistance? So we could look at that and say, I'm looking at that, and that looks like a bit of a shooting star to me. And now what are we, John, you're absolutely right. So what are we waiting for? Confirmation. We were looking for the candle the next day to be below. And did it go below? No. So then someone said, hey, could we, instead of calling it a morning, could we call it a morning star instead of a shooting star? But, you could say, well, hey, if it broke through this level and we consider this now, maybe it was a resistance level. That's how we were looking at it. It turned out to be a support level. So then could this be looked at instead as our inverted hammer? So this is an example where it didn't give us that confirmation. Okay. And so it's important that we look at both. So if we look at Goldman Sachs, here's an example. And in fact, I think we placed a trade on this day. So we had this inverted hammer, and the next day, where did the body close? Above. And so we had this inverted hammer, after you could say this was a bull flag pullback. Let me just, so this started to move up, right? And then it moved up again, and we had a 1-day pullback, and then it came back, moved up again, pulled back. And so this is, at a potential support level. And so we put 2 trades on. We did a short put vertical, which is a neutral to bullish trade. And we also did a long call vertical. And that's an example where, there was a confirmation. And if you missed it the first day, then the next day could have been a confirmation. Okay, let's look at another one. Yeah, and dojis can happen anywhere on the chart. Now, they're seen to be more significant if they happen at a support level or at a resistance level. Okay. Then I should have put down the date I was looking for here. So here, I'm going to draw your attention here. So we had this support level, we had something that had kind of gone up, pulled back, and then what pattern do we see here? Oops, sorry. What are we seeing here? So we had here we had a low, we had a higher low, and then we get this Harami pattern. Yeah, we get this Harami pattern. Now, the next day, we have this candle pattern. You could call it an inverted hammer. You might say, ooh, is that going to be, a shooting star? Like, how do I look at this? Well, you'd say, well, here was a low, a higher low. And if we're thinking that the tide may be turning, here was our high, our higher high. This is kind of in a bit of no man's land, isn't it? And in fact, it turned out, if you were looking at this, it's just part of the trend. But then we get up here and we have this shooting star pattern. And what are we looking for? We're looking for confirmation the next day because we now have had this big run to the upside, right? So we are looking for it to pull back. The next day, does it pull back? It does not. It does not. It doesn't pull back until the day after. And so, on this day, we might say, well, now I have confirmation that this trend may be changing, and it did pull back and then it's taken off again. Okay, let's look at Wells Fargo. Okay. Now, again, and this is where having a trading plan and having rules, and this is why I'm showing you some examples where we didn't get the follow through. because it can become so easy when, we're excited and we're confident and we're developing this competence to jump the gun. And that's why I'm doing all these short little videos. And so again, we had something that has been moving to the upside, right? And then it came back here. And so let's look first at this one. So it was, so we were kind of moving up and then it pulled back and we got what? You might call it a hammer or a doji. It's a small body, and it's pulling back. So could this be establishing a new support level? Well, what we want to see is confirmation by having it trade above the next day. So if you're looking at this and saying, hey, tomorrow I'm going to be golfing, could we have put in a conditional order to say, hey, if it goes above the body of this candle, get us in? Then we would have gotten in right at the beginning of the next day. And if it had gone down, then we wouldn't have ended up placing the trade. Okay. And then it's come up again, pulled back for a day, come up. We had a little bit of a pullback. And then yesterday we had this candle pattern, which you may be saying, I'm going to get out my chart. I'd call this either a dragonfly doji because the body's really small. You could also call it a hammer, and I'm not going to fault you for that. But if we call this a dragonfly doji, what are we looking for to say, hey, this is happening at a resistance level? Are we going to place our trade and, sell a short call vertical or something? No, we're going to wait until the next day to see if it closes below. And did it? No. It did not. And so this is where having a plan and following your rules can mean, it can save you a lot of money, because it would have turned out if you'd placed that trade, assuming it was pulling back and placed a trade that was based on that, it would likely have not gone well, would it? And it's hard to be patient sometimes when we can see something and we think it's pretty obvious. And, let me just close my drawing tool. And, if you like to draw lines on charts, as we all know I do, and you're saying, well, it's, and the way I would describe this as it's flirting. And when something's flirting, it hasn't really committed yet, has it? So we want to see it maybe break out and then come back and retest. And so today we have more confirmation of this uptrend continuing. Let's look at IBM. So here we had a pattern where, we had a diagonal resistance breakout here. It came back and retested. So is this old ceiling going to behave as a new floor? Old resistance, is it going to become new support? And then we get this candle. So it's a hammer with a really, really long tail. Now, do we place the trade yesterday? Because this is happening at an old resistance, new support area. Some might say, well, if we're following our rules, the rules say you wait for confirmation. And today would be our confirmation. And again, if you had said, and sometimes things can open higher and then pull back. I mean, we've seen that happen. But, if you'd put in a conditional order yesterday, you would have been in then. Now, what if we said, okay, so today, if this were the end of the day, we'd have our confirmation. What type of trade might we like to place? Well, you might say, I got out of a lot of stuff back, when the market was reacting really bearishly. And so I have a lot sitting in cash. Well, could we do a buy right covered call and buy 100 shares of stock and maybe sell the 260 or maybe even the 265? sell a covered call. And this might be, maybe you're saying, you know, I really, I could do a longer term buy and hold, but I think I'd really rather, I'm looking to make some money. I'm setting up a little fund. I want to buy some new living room furniture, or I want to go to Paris, or I want to, you know, take the grandkids to Disneyland, whatever it is. And so this is what I'm trying to do here. And so if we're trying to generate some income, could we come out to June and our example trading plan might say, hey, does it trade 1 million shares a day or more? Yes, check. If I look at the 260 or it's at 258, the 265 or the 270 strike, do we have lots of open interest? Yeah, we've got tons, right? We've got thousands, hundreds or thousands of contracts. Do we have a tight bid-ask spread? Well, that's 20 cents. So that's, you know, pretty appealing. This is 15 cents, so that's fine. So if you want the probability of being called out to be higher, you want the strike closer to where it's trading. So if we chose the 265 strike, we get paid between 485 and 505. There's a 73% chance of it coming up and at least kissing that 265 strike, at least flirting with it, and a 36.8, based on where the stock is currently trading, chance of it being in the money at expiration. And so if we look at this and say, well, that looks appealing to me, how much could I make? Well, if you're just eyeballing it, you know, you could make about $6.50 a share on the stock going up, plus another $5. You could make $11 a share. That's not too shabby. If you want to get specific, and, you know, let's get specific. Why not? We're going to come up here and say, okay, so we're buying covered stock. So we're buying 100 shares of stock. We're selling a covered call. We want to get called out. That's the goal. So we're seeing an uptrend and we're selling our call kind of in the middle of the road. And our net cost to get in is $253.64. So if I bring out my calculator and I say, okay, the most I can make is $265 if I'm called out, and I subtract what I'm paying to get in, which is $253.64, and the most I can make is $11.36. Well, you know, that's $1,136. And if I divide that by what I'm investing, $253.68, that's a 4.47, almost a 4.5, like it's a 4.5% return for a trade we'd be in for a maximum of 38 days. So this is not a long-term love affair. It's a buy-in. I call it a dating strategy. So what we could do is we could look at this candle here or this candle and say, you know, we have a support level around this kind of our 249.43, this resistance level, which became a support level. So if I took that 249.43 and we multiply that by 0.97, I'm just doing that on my little calculator here, my stop would be at 241.95. And so if I look at that being my support level, my stop, if my stop's at call it 242, and we're in at 253, so we're risking about $12 a share to make 11. So it's close to a 1-to-1 risk reward ratio. Now, we don't know what our stop, we don't know what that call would be worth if we get stopped out. So we're going to come to our single order, change it to a first trigger sequence. We're going to right click, create an opposite order, and make it a market order to both buy back the call we've sold and sell our shares if and only if. I'm going to click my disappearing, reappearing sprocket. If and only if IBM goes at or below 241.95. Okay. So there's our confirm and send. So the most we can make on this trade is $1,121. The most we can lose, it doesn't take our stop into account. It's saying if the value of IBM went to zero in the next 38 days, we'd be down 25,000. But we've got a stop in, and that stop doesn't guarantee we'd get out at exactly that price. It would trigger a market order to sell. Now, I taught another class earlier today, and we did an example of this kind of strategy on Rivian, and you can see a similar type of pattern happening here, a diagonal resistance breakout. It pulled back, retested, and has moved to the upside. Now, could we look at, are there others we could look at? There are. I'm going to have this buy right covered call as a topic for after the close on Thursday. So if you'd like to join me for that, you're welcome to do so. But I hope you found this class helpful. So here's my ask as we wrap things up. One, if you are not following Brett Crowther and I on X, I invite you to do so, Brett Crowther CS and Barb Armstrong CS. Next, if you would do me a favor and hit the like button, one, it lets Brett and I know that you found this class helpful and valuable, but it also moves it up in the YouTube algorithms the more likes we get. So you could be doing a favor for a random stranger whom you may never meet just by hitting the like button. So that checks something off your list, today, and helps me out as well. And then if you haven't subscribed to the channel, you're going to want to do that. So if you hit the subscribe button, where that will take you is to the Trader Talks from Schwab Coaching on YouTube. And then when you bring that up, what you will see when you first get there is whatever is currently being taught. So right now that's getting started with technical analysis. If you come to the playlists, and they're in the Getting Started with Technical Analysis series also, but if you come to the Trade Management Mini Session series, I was able to group them all at the top. So the first four, the hammer, the hanging man, the inverted hammer, and the shooting star are here. This weekend, or this week, my plan is to add another 4 or 6, or we'll just see what kind of roll I get on. So you'll want to take advantage of those. So if you want to do some binging, you'll see these are like 3 minutes, 34 seconds, 4 minutes. I'm trying to keep them 4 minutes or less. Okay, so guys, that's a wrap for today. Thank you so much for joining me. Make sure you come back next week. We'll tackle another topic in the world of technical analysis. Up next is swing trading with Mr. Mike Fairborn. Stay tuned. Lots of good stuff still coming your way. Bye for now.